All right, welcome back, traders. John Caruso coming to you here Sunday evening, February 5th. Another edition of Futures Forecast for the week beginning tomorrow, Monday, February 6th. We're going to take a look at about 4 or 5 charts later on in the segment here, but first we're going to review and recap some of the data that we did see get released last week. First week over week performances, the S&P 500 finished the week up 1.2%. NASDAQ was up 3.5%. 10-year yield finished down 2 basis points. But that doesn't even begin to tell the full story of the 10-year yield last week. At one point, we did actually see it down 22 basis points before reversing on Friday's jobs numbers back to the upside to finish basically flat on the week. Oil, energy had a bad week last week. We did see oil finish down 8.84%. RBOB gasoline down 11% on the week. And gold finished down 4.5% on the week. U.S. dollar actually had a pretty meaningful reversal. We're going to take a look at that on the chart. Going forward, U.S. dollar was up 1% last week. So last week was pretty much kicked off. We did see the JOLTS report that came out on Tuesday. We did see an increase in job openings, which is still further evidence that the labor market remains very tight and very favorable for the American worker. But the Fed kicked off on Wednesday. That was kind of the highlight here of the week. The Fed kicked off up. They did actually raise a quarter basis point to 4.75%. They did mention the idea of ongoing interest rate hikes. So we still think that they're going to go for 5% at the next meeting. And whether or not they can get to 5.25% following that, that still simply remains up for debate. But we actually do think that there's pretty good odds that they're going to get to 5.25% by later on this spring. So it's going to be interesting to see how that played out. But no doubt did we hear from a less hawkish Powell at the 1:30 press conference following the release of the statement. So very much less hawkish than what we've grown accustomed to over the last 12 months. It seems as if Powell's starting to move into a more data-dependent state of mind. So it's going to be interesting to see how that plays out. Obviously, Friday's jobs number, if he is data-dependent, and certainly looking at the labor numbers, obviously these very strong jobs increases that we've seen would certainly support another 1 to maybe 2 quarter-point interest rate hikes coming over the course of the next 2 Fed meetings. But nevertheless, we did see stocks rip higher on a less hawkish Powell. Yields did drop to as low as 338 on the 10-year yield at one point. And then, of course, on Thursday, we did have that highlighted by mega cap tech earnings, where we did see disappointing earnings pretty much across the board from mega cap tech. Apple, Amazon, and Google all did disappoint for the most part on earnings per share as well as revenue. We did see Apple experience the weakest sales revenue since 2016. We did see poor ad revenue coming from YouTube for Google, and Amazon reported their weakest holiday sales since 2014. So disappointing mega cap tech earnings. Also on Thursday, something interesting happened kind of under the surface. We did see U.S. equity call option volume hit a record high, and that was set on Thursday. 40 million call options were traded on Thursday alone. So there's a lot being made in the media right now about these 0 date to expiration options. Those seem to be all the rage right now on Wall Street. That are suppressing front-month volatility and creating this unabashed buying in U.S. equities, which has driven the S&P 500, as you can see here on the charts, much past through our resistance areas, and is certainly painting the tape in a much more favorable light, so to speak, on the charts. So we're going to get into that here shortly. Friday, of course, we did see the U.S. non-farm payrolls report saw a blowout number, 517,000 jobs created in January. The market was looking for 185,000. So that was a massive, massive blowout number. Wages did increase 4.4%. Unemployment fell to 3.4%. Expectations were for 3.6%. So we still stand pat in our view that you're not going to see a pivot by the Fed until you start to see the labor numbers begin to turn over. But we have yet to see any signs of that. Of course, we have the strong JOLTS number on Tuesday, and then, of course, that's backed up with the blowout number on Friday. So let's jump over to the charts right now. So you can see we're still staring at the S&P 500. This solid red line that I have drawn on here, this is the downtrend line the market's largely respected over the last 12 to 13 months. We have been able to power through that level since the turn of the year. I believe for the year, I believe the S&P 500 is up just about 6.5 to 7% year to date. So the S&P 500 has put a lot of weight on in a very short period of time. And because this upward impulse and upward bias of the market has been so strong, this next area of risk and pull down, we think is just going to be that, where perhaps it gets down and retests this 4,000 area, perhaps mid to late February, before we get another retest of these old highs in here. This gray shaded box was a period of resistance that we thought the market that would stop the market, and it actually did power through that area. But we are falling back into that period of resistance right here, and we do think ultimately we're going to chop our way back down into 4,000, perhaps get another rally going into late February, perhaps into perhaps mid March, even going into option expiration in the S&P 500. But then ultimately think another big breakdown is coming deeper in the spring that could take us into late March, early April time frame. So still think we're in a pretty big period of risk in the market. We do have growth slowing. While the inflation data is slowing, that's viewed largely as a net positive. The growth figures in the economy, our Q1 GDP tracker right now is expected. It's tracking at minus 2.3% for U.S. growth in Q1. Of course, we're not going to get those numbers out until April. So clearly, we still think we're in a period of risk going into the spring, but perhaps this pull down is just a shallow one here over the next 1 or 2 weeks before we get another retest of these highs up in here and then another breakdown deeper into the spring. So that is a look at the S&P 500. We're going to look at the volatility index briefly here, and I'll show you where our analysis did actually have this going into a choppy period out into here, but we did actually think that volatility was going to turn up a lot sooner than what it actually did. And perhaps these zero DTE options had something to do with suppressing volatility, where we did actually see it break down into this low 17 handle. We did get an immediate term oversold signal. I believe that was on Thursday. Saw a big bounce, and we do believe that we're in a period where we're going to start to see volatility start to bottom and turn back on the upside. Perhaps we get some chop, and then we get another move, perhaps into 28, 29, going out into the springtime, and we think that's going to be consistent with a period of risk in the stock market, like we just showed you there in the S&P 500. So let's jump over to the gold market. Gold had a pretty key reversal Thursday and Friday. Gold finished the week once again. That was down 4.5% on the week. We did actually think that there's an opportunity in here for a trade, alongside trade in here, where we could see some chop back into 1910 to 1920 before perhaps this gets hit one more time on the downside into late March. And perhaps that is consistent with risk off in the market, risk off in stocks like we had mentioned. But ultimately, we are still very favorable on gold on a longer term time frame, where we think ultimately gold at some point later on this year is going to make an all-time high. And of course, we're going to see whether or not that is consistent with how the Fed steers policy going into the back half of the year. So very interesting. But the daily chart right now, it is giving me an oversold signal in gold. We are starting to see a slight change in momentum from positive to neutral. Isn't that amazing how that happened? We had all this positive momentum, and then in a matter of 2 days, it just completely wipes out the momentum. Momentum is beginning to neutralize. That doesn't mean that we can't turn back to the upside and turn green again. But I ultimately think while we bounce in here, it's going to be bouncing with neutral momentum before perhaps we get another hit back on the downside that takes us into about 1800. Perhaps even as deep, if it's a washout, perhaps even as deep as 1750, which would be consistent with this old swing low and this old swing high over here, where gold really made its turn and broke to bullish trend in our model. So maybe we get a retest of that trend line of about 1740 before we get another big move back on the upside. But ultimately, we remain bullish on gold. I'm going to be looking at buying gold and grossing up positions throughout this period of perhaps risk throughout the springtime. We're looking kind of at the bigger picture in gold, and we're not going to try to play that, take a short-sighted view there. So that is a look at the April gold contract. Here is March dollar. Now, this is consistent with a near-term top that just developed in the gold market. Pretty key, meaningful reversal in the dollar here last week. Of course, we did hear from the ECB last week as well. So with this big move here, it's now giving me an overbought signal. What I think could happen is we could chop and pull down one more time before we start to see it chop back into possibly 104, possibly 105. And then, of course, keeping consistency inversely to the gold market, we do think that there's going to be another breakdown in the U.S. dollar coming deeper out into the springtime. But I actually, believe it or not, we signaled some long side positions on Friday in the gold market, and we actually do have a small long side position in the dollar market right now. So it's interesting to play that dynamic right now. You know, basically on oversold days in the gold market, we're looking at grossing up our gold positions, and we're looking at trimming back on our dollar positions. And I think that dynamic could play out like we mentioned throughout the springtime. But ultimately, we want to get to a place where we are holding more gold on the long side than long dollars, and we think that dynamic is eventually going to win out. I actually do think at some point out here, we will eventually take off our bullish call on the U.S. dollar and eventually flip bearish. But believe it or not, this trend is still holding on to a bullish bias inside of our model. I'm going to show you that here on the monthly chart. So clearly, you see all this upside action. This is the longer term trend line, which we tested this past week and held. So I do think that there's going to be another trade that comes back into here to the 104 to 105 area before it tires itself out. And then once again, we break back on the downside. So that's a look, a longer term look at the US dollar index here. Now, lastly, we're going to flip over to the March crude oil contract. And admittedly, I actually had this wrong over the last couple of weeks, where I actually thought what was going on here was a bottoming process in the crude oil market. And with us breaking back through this immediate term trend line and retesting this 72 area in crude oil, that proved my analysis proved to be incorrect. So very mature downtrend that we're staring at in the crude oil market. We had the breakdown of this immediate term uptrend that happened back on the February 1st. Breakdown, momentum broke down, and here we are. We are getting an immediate term oversold signal, so perhaps we do get a little choppy bounce into here, and perhaps we chop our way back down, perhaps into that 66 to 65 area in crude oil. I'll show you that here on a longer term view, why we think 65 could be a downside target for crude. And you can see this old swing low down here, this shelf. This was actually a very important shelf that we saw in crude, where it was kind of faced with a potential breakdown under this area, but it rescued itself, and that's when we saw the big move higher, the moonshot higher out into the early spring last week. So I actually do believe that we're going to retest that level. That was a very key pivotal level back at the end of 2022, and it looks as if we are going to try to retest down into 66. Of course, if we do break that 70 area first. But ultimately, we do think somewhere out over into here, perhaps late in the spring, into the summertime, we are going to see an upturn in crude oil prices. But we're not quite there yet, clearly, and we still think that you want to be trading crude oil with a negative bias going forward. So that is a look at some of the markets and a quick review of the previous week. Once again, I'm John Caruso. If you guys have any questions, any chart requests, anything, feel free to reach out to me at jcaruso@RGO Futures. I'd be more than happy to go through any other charts with you guys and give you our analysis. Also, if you are joining us from Paradigm Futures, welcome aboard. If you have any questions, feel free to reach out to myself, or you can reach out to Jamie at paradigmfutures.net, and I'm sure he'd be more than happy to help you out with any analysis as well. So best of luck to everybody out there. We're going to catch you back here next week. Take care.